Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. Stocks have been melting up here ever since the collapse of SVB, ever since the banking crisis, on this euphoric rally here, completely disregarding any risk of financial contagion and completely focusing on the idea of a Fed pivot. And what we're actually seeing is that on this rally, we're getting a signal that we haven't had since the dot-com bubble. The behavior of the market is similar to that of 1973 and the very top of the credit bubble in 1929. The underlying behavior of the stock market that we have in today's environment, today in 2023, is similar to those iconic market tops. I'm going to show you exactly why in this video, what that means for the market. First, I want to make a quick announcement. We're doing a special offer on the membership. We're giving out 1 whole month for free for you to test out the service. This offer is only going to last a few days. You'll have access to all the features on the website. The aim is really to make sure that all of you are testing out the service, getting the value out of the work that we're doing. We want the barrier to entry to test out the service and actually see the value that we provide to be as low as possible. So hopefully as many of you can become more successful in the markets as possible. All you have to do is go to the website, scroll down to the memberships, and click on free trial. You'll automatically have a 1 month free trial. Again, this is a limited offer. So before we look at the actual weakness that we're seeing underneath the surface on this rally, let's think about the counter argument to being bearish in this thesis. Now, a lot of it is based on the idea that sentiment is very depressed right now, and it has been for quite some time. You look at AAII Bulls, which is a survey of individual investors asking them whether they're bullish on the market. And if you look at a 50-period moving average of that indicator, we are at the most bearish levels in recent financial history. You zoom out all the way to 1990, and we've never been this bearish except for briefly in 1989, briefly in 1991. So the idea right now is that, well, the Fed is suddenly backing the markets right now. We're seeing the end of the hiking cycle because of the banking crisis. SVB collapsed. We have increased odds of fragility in the banking system. And so the market is seeing that and saying, okay, the Fed is going to pause monetary policy now, but we don't have a recession yet. So money's going to be easy again. The labor market is strong. The consumer is strong. And so we can price in an economic recovery as the Federal Reserve pauses and potentially even eases monetary policy. And so you're going to get all of these bears in the market right now back into the S&P 500 and push the market higher as you climb the wall of worry, as things get better in the market. But you're going to see more and more capital become allocated to stocks, and that's going to push the S&P 500 higher. And you can argue that's what's happening right now. Stocks have been getting optimistic. And so a lot of people are wondering, was the SVB collapse, was the banking crisis actually not the bottom of the market? Well, in my opinion, probably not. We are seeing evidence that this rally that we're seeing is not very sustainable, that economic fundamentals are deteriorating right now. If we look at what is currently driving the S&P 500 higher right now, it's just a handful of stocks. Now, this is an indicator that shows the percentage of S&P 500 stocks that are actually outperforming the S&P. You can see that this indicator came down very violently more recently during this bear market rally right here. Something we haven't seen to this extent since 2000. Right here, you can see that corresponds almost to the exact top of the dot-com bubble. We had a similar signal right here, 1973, at the exact top, or following the exact top of 1973. And we also had the same signal in 1929. Now, there were some other signals right here in 1934. That was another interesting top. Right here, 1952, not a massive top, but it was the end of a pretty significant rally in the market. Here in 1955, very similar, marked the top of a significant rally that was followed by a reasonable drop in the market. But in this video, I want to focus on these three iconic tops, 1929, 1974, and 2000, and try and understand if these are in any way similar to the setup that we have today from a macro standpoint. Because again, we want to understand the underlying fundamentals in this economy. And so is the behavior that we're seeing in the market right now, where very few S&P 500 stocks are actually holding up this rally, whether that looks in any way like these setups here that were followed by more downside. Now, starting with the 2000 top, let's first add the federal funds rate, see what the Fed was doing back here. It was tightening monetary policy very aggressively, very similar to today. The yield curve was deeply inverted right here. You can see we had a very deep yield curve inversion back here in around February to April of 2000 that coincided almost with the exact top of the market. You can see we clearly have a similar signal today. Deep yield curve inversion, even deeper than what we had in 2000. And so that yield curve inversion was quickly followed by a recession. So we do have some fundamental similarities with what was happening in 2000. The Fed was tightening leading up to the top, and we had a yield curve inversion. And that was quickly followed by a recession where you had unemployment rate beginning to rise. And that's actually where you had that signal right before unemployment began to rise in 2000, where a handful of stocks, big mega cap stocks, very similar to today, were rallying in a euphoric move here because the unemployment rate was low and the Fed had stopped tightening. Now, the big question is whether or not we'll see the unemployment rate rise. I'm going to show you a chart in just a minute that does seem to suggest that's what we're going to see within the next few months. But first, let's take a look at 1974 and see if we have any similarities whatsoever with what was happening here. Let's take a look at the federal funds rate. Well, monetary policy was tightening significantly. And if we add the unemployment rate around this area here, right following the top of 1973, when you had this signal here, this signal telling you that most stocks were actually lagging behind the S&P 500, look at what the unemployment rate was doing. It was low, right? It was falling. And in fact, right here, you had a brief moment where the Fed was easing monetary policy. So that's where you had that signal, where you essentially had a Fed pause. You had the unemployment rate that was low. And if you look at the yield curve, guess what the yield curve was doing right here when you got that signal? It was, of course, inverted. So hopefully you're starting to see a little bit of a pattern here. You've got a yield curve inversion. You've got the unemployment rate that's low. You've got the Fed that's pivoting. And you've got a handful of stocks that are holding up the market. Now let's look at 1929. Now, not many people can actually find data on this, but this is all data from the Federal Reserve's website. Let's see what was happening as you got that signal right here at the top of the 1929 credit bubble, where very few stocks were participating in the rally. Of course, you had the Federal Reserve that was tightening. This is the 3-month rate from the Fed. Monetary policy was tightening leading up to the big top. And then you had a Fed pause. You had the Federal Reserve pivot on monetary policy. Look at where the unemployment rate was back here. It was low. So you had yet again an environment where a few stocks were getting very excited about a Federal Reserve pivot while the labor market was very strong, unemployment was very low. But if you look at the yield curve back then, it was inverted. It was telling you you were going to see a recession, which of course ended up being the case in 1930. So when we look at this type of chart with these types of signals, it's very easy to disregard them. But when you actually look at fundamentals and the actual story behind these iconic tops, you find that it's not all that different to what we have today. A yield curve inversion that's signaling a recession, a handful of stocks that are getting excited about a Federal Reserve pivot because the unemployment rate is still very low. But this week we actually had the most recent job openings data that came in much below expectations. You can see a very rapid drop here in job openings. Now, if we compare this chart to the unemployment rate and we inverse the job openings, so you can see it looks a little bit more like the unemployment rate, and we add the unemployment rate on this chart, you can see most of the time they actually go in line with each other. Job openings go together with the unemployment rate. And now right here, it's been a few months where we've seen job openings really signal that the economy is weakening, and yet we haven't seen the unemployment rate really begin to rise here. So we think that's the next shoe to drop. We do think the unemployment rate is set to rise right here, and that job openings are actually being a leading indicator of the unemployment rate right now, which explains the dynamic that we're currently seeing in the market today. So I hope you guys enjoyed this video. If you did, make sure to smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.